Hello and welcome to episode 39 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover today on the podcast is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as a merger arbitrage tool, check out insidearbitrage.com. Please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 or 5 key stories, including the largest leveraged buyout, when a consortium of investors decided to buy the video game publisher Electronic Arts, the spinoff of Alphabet's lifesciences division, a large stock buyback announcement at a rare disease-focused biotech called Catalyst Pharmaceuticals, an interesting insider purchase at Miami International Holdings, and activist involvement in the mental health company Acadia Healthcare. Before we begin, we want to state that nothing on this podcast is meant as an investment advice. Please refer to our full disclaimer at the end of this podcast for more details.
We are going to kick off this episode with an update about a rumored deal, or deals in the works as we like to call it. Back in July, Bloomberg reported that power generation company AES, which supplies power to energy-hungry tech companies like Microsoft, was exploring options, including a potential sale after receiving takeover interest. The stock was trading at about $11 per share when that news came out, and jumped up to a little over $13 after the news. The stock has lost almost half of its value over the prior 2 years, and last week we received an update from the Financial Times that BlackRock and Brookfield-owned Global Investment Partners is nearing a $38 billion deal to buy AES. AES has a market cap of just a little over $10 billion, but their massive net debt of almost $29 billion is what brings up the enterprise value close to the potential acquisition price of $38 billion.
So that's a very massive debt balance. Aside from inflating the potential acquisition price, why else might that debt be significant?
Yeah, for 2 reasons. One is that it adds even more leverage to global infrastructure partners. And the second more important reason is the deal might impact the trading of the bonds of AES, depending on what the merger agreement says about the existing debt of AES, and whether it'll get rolled into global infrastructure partners or some of it gets paid off. Moreover, there is going to be a difference between the credit rating of both the acquiring company and the target company, and that can help the bonds in this transaction. In fact, this behavior of the bonds in an M&A transaction provides a good segue to one of the largest leverage buyouts in nearly 2 decades that was announced last week. As we discussed in our last episode, a few days before the official announcement, the Wall Street Journal reported that Electronic Arts was in advanced talks to go private in a roughly $50 billion deal. The stock was trading at about $168.36 when the report revealed that a group of investors, including Silver Lake, Saudi Arabia's PIF, and Jared Kushner's affinity partners, would be involved in the deal.
This was a fairly rare situation where news of this rumored deal actually leaked during market hours, right?
Yes, indeed. You don't normally see that. The news comes out pre-market or comes out after market. But this news came out about an hour and a half before the market closed on the Friday before the official announcement came out. And EA stock actually jumped 15% to $193 and change that Friday. The deal was confirmed last Monday as an all-cash deal for $210 per share. And interestingly, even though the stock had jumped up to $193, there was still upside left by the time the deal was actually announced. What was more interesting to me was I saw a tweet discussing this deal last week where a credit expert mentioned how EA's bonds were trading well below par, and they will likely get settled at 101% of par due to the change of control clause in the merger agreement. While a lot of people were focused on how some options traders made a killing on buying EA, short-dated calls before the close on Friday, the bond situation is actually quite interesting. We've been tracking deals in the work situation since 2017, And once a year, we analyze summary data regarding all of the information that we have for rumored deals. The last time I did this was in April of this year, looking at what happened to nearly 1,000 deals in the work situations.
So, looking at all that data, what kind of success rates are we seeing in terms of rumored deals?
Before we started tracking this data, I used to pay very little attention to deals in the works or rumored deals because it felt like, most of these end up actually not coming to fruition. What surprised me when I looked at our data was that 42% of rumored deals actually translate to a confirmed deal. I won't go into all the gory details of what we discussed in that April newsletter, but getting back to the current EA situation, the bonds offer a way to participate in rumored deals without as significant of a downside that stock or options would have if the deal does not materialize. Now, if more investors start paying attention to the bonds and volatility increases around rumored deal news, then this opportunity will also no longer exist.
That's fascinating. Moving from rumored deals to rumored spinoffs in the spinoff section of our podcast, over the past few years, Google, or Alphabet as the parent company is known, has been involved in a number of antitrust lawsuits, primarily centered on the company's dominance in the search engine and digital advertising markets. At the moment, Alphabet is in court arguing the Justice Department's case, alleging that Google illegally monopolized advertising technology. A big concern at the moment is the technical feasibility of moving parts of Google from its proprietary infrastructure to the cloud. The Justice Department has asked the judge to force the company to sell its advertising exchange, while Google argues that a sale would be technologically difficult and end up harming customers at the end of the day. However, Heather Adkins, Google's vice president of security, stated that the company has been working for the past 2 years to technologically decouple its life sciences unit in Verily, which is a fancy way of saying it wants to move it off of Google's own infrastructure and onto the Google Cloud platform such that the business can eventually be sold or spun off.
That's interesting. I think we've looked at Verily briefly in the past. What exactly is Verily and why do we recollect coming across this in the past?
Yeah, exactly. So Verily was formerly known as Google Life Sciences, and it used to be a part of Google X, which is Alphabet's semi-secret research and development facility where a lot of new and emerging technologies come out of. In October 2023, the CDC had selected Verily to support the agency's National Wastewater Surveillance System, and wastewater is a big part of Google Life Sciences or Verily. And additionally, the business has been selling off its extra parts. In January 2025, Verily had signed an agreement to sell its stop-loss insurance unit called Granular to Elevance. Now, why we might potentially recognize the company is that rumors of a spin-off have been brewing since August 2023, when Verily's CEO had announced that the company would start to end ties to several of Alphabet's services. However, it has been 2 years with no significant announcement about a Verily spin-off, save from this one remark during the trial. So I'm curious to see how the situation will continue to develop, if at all, and what the timeline might look like for a potential spin-off.
Yeah, Google has so many of these research projects, if you will. For the longest time, Waymo was in that category as well, and now is generating revenue and is on the forefront. But I think it has so many of these irons in the fire. You never know what happens to some of these. And it'll be good to see what happens with a Verily spinoff.
Right. But moving to more established spin-offs, the Honeywell spin-offs are a topic that we somehow bring up every other podcast at this point. But it was good to see that Honeywell has set October 17th as the record date for the spin-off of Solstice Advanced Materials, with distribution set to be on October 30th. Shareholders will receive 1 Solstice share for every 4 Honeywell shares, with Solstice to begin trading on the NASDAQ on the same day under the ticker SOLS. As a brief recap, Honeywell, the parent company, operates in 4 main industries: aerospace, technologies, industrial automation, and energy and sustainability solutions, and building technologies.
So where does the advanced materials business fit in, and what is it going to do?
The advanced materials business will focus on sustainability-driven specialty chemicals and materials including fluorine products, electronic materials, industrial-grade fibers, and healthcare packaging solutions. So fairly diversified, and it has leading brands like Solstice, which the company is named after, Spectra, and Hydronol. I believe the business brought in about $4 billion of revenue for Honeywell as a whole in 2024. So it's a pretty sizable market, and we'll see how growth continues over the next few quarters and years.
Elliott management will probably be quite happy that these spinoffs are finally happening.
Yes.
Switching gears to stock buybacks, Progress Software, a company we wrote about as a spotlight idea in our August newsletter, announced a $200 million stock buyback last week, representing 11% of the company's market cap at announcement. Progress Software is a $2 billion market cap company with operations across all 6 continents. Over 70% of the Fortune 500 use Progress Software's products that span digital experience platforms, application development tools, secure file transfer, infrastructure monitoring, and DevOps automation. So quite a bit of diverse technology software solutions across the board. We came across the company after seeing a purchase by a long-serving director who made his first purchase of the company after 17 years on the board. So he waited a long time before figuring, hey, I should buy some stock on the open market now. The CEO of the company also purchased shares, making the first insider purchase at the business since 2020. Following the departure of one of its founders, the company went through a series of 5 CEOs in a short span of time before finally settling on the current management team, which appear to be both competent and have an equity-heavy compensation structure. Progress has mostly been growing through a series of acquisitions, and this has left the company's balance sheet with nearly $1.4 billion of net debt, and that might partially explain why the company has a high short interest of 13%. Unlike Canada's Constellation Software, that is highly popular among investors, which tends to acquire businesses and then just hold them without changing each company's operations a whole lot, very much like what Berkshire Hathaway does, Progress Software integrates its acquisitions, which makes it easy for them to cross-sell its other products. Overall, we like the situation where the company insiders are buying stock on the open market, and the company is also planning to buy back stock through its stock buyback program. We like to track these kind of companies with this dual action, if you will, in a custom screen we call the double dipper. While Progress Software is interesting, a second buyback announcement we wanted to mention this week was Catalyst Pharmaceuticals authorizing a $200 million buyback program that represents 8% of its market cap at announcement. What really caught my eye when I took a look at the company following the announcement was that the company scores 93 on our IA score quant model.
So 200 million buyback representing about 8% of the market cap, that means Catalyst is a fairly large company. Does that mean the company is pre-revenue or pre-net income and clinical stage? Or because of its size, are we seeing the company generate revenue with approved products?
That's a very good question. Unlike a large number of biotech companies we come across that are at the clinical stage, Catalyst has multiple FDA-approved products with a specific focus on rare diseases like Lambert-Eaton myasthenic syndrome or LEMS and Duchenne muscular dystrophy or DMD that cause muscular weakness. The two diseases are actually quite different in many ways, including where LEMS mostly impacts adults while DMD shows up in early childhood. LEMS is an autoimmune disease that shows up in adults with cancer, and DMD is an inherited structural muscular disease. The company estimates that the total addressable market share of each of these diseases is over $1 billion. As you know, there is a lot of competition on the DMD side, with Sarepta Therapeutics, an early leader in the space, that has taken a very hard hit in recent weeks after multiple patient deaths due to liver failure. So there's some toxicity concern about the drug that was, if I remember correctly, the first to market for DMD.
Right. I wonder if that'll continue over in that Catalyst as well, or if it'll be an opportunity for the company to come through with their drug.
I was discussing DMD and the impact on Sarepta with a friend, and he mentioned another company that also has a DMD-focused drug in development. I don't recollect if it is Catalyst or he was talking about a different company.
I believe that was Dyne Therapeutics, another company that focuses on DMD that we actually discussed on this podcast in previous episodes.
Absolutely. It's interesting to see so many companies focused on DMD at this point.
Yes, indeed.
Catalyst also has an approved product for epilepsy, but I'm not seeing a lot of pipeline depth beyond these 3 approved products. The company's financials actually look stellar with increasing revenue and a growing cash balance on the balance sheet, and hence the high IA score of 93 that we saw. While revenue is growing, earnings and free cash flow appear to have flatlined over the last few quarters, and that might explain why the stock is only up 6% over the last year. I would much rather see them focus on their pipeline either through internal research or through acquisitions, but I can see why they want to buy back stock, considering it's trading at an EV by free cash flow ratio of just 7.
Absolutely. Really interesting company, but let's move on to our insider section. Now, it's very rare that we talk about insider purchases at a company that just went public because often there's not much to discuss. But we decided to make an exception for Miami International Holdings for multiple reasons, actually. The company, which was founded in 2007, completed its IPO on August 14th of this year, and shares have soared by over 26% since the first day of trading.
That's interesting. What does Miami International do besides probably being based in Florida?
Yes, Miami International Holdings is a technology-driven holding company that builds and operates regulated financial marketplaces across multiple asset classes and geographies. The company has grown from a single options exchange launched in 2012 to the fourth largest US options operator and then the 15th largest global derivatives exchange, through a mixture of both organically launching new exchanges and then acquiring others. The company derives revenue from 6 primary streams, the most significant of which is transaction fees on executed trades.
I would expect that this would be a very competitive space. So, what does competition look like for Miami International?
You're right, it is fairly competitive. The top 3 operators in the US options market, CBOE, or as the company likes to call itself, CBOE, NASDAQ, and the NYSE collectively dominate most of the market, leaving Miami International competing for the remainder alongside smaller players like the Box Exchange and MEMX. CBOE in particular has a near monopoly on index options, which is something that Miami International will struggle to overcome. Index options tend to generate higher margins than equity options due to their complexity and institutional customer base, but proprietary products like the SPX options are exclusively licensed to CBOE. The recently approved Texas Stock Exchange is also worth considering. While the TXSE is set to be focused exclusively on stock listings and equity trading, not options or derivatives, the TXSE can in some sense compete with Miami International's own equity trading exchange, MIAX Pearl Equities. However, given that equities represent such a small fraction of Miami International's business model, and that the company's equity market share is already quite minimal, the competitive impact from TXSE is rather negligible. In fact, the Texas Stock Exchange may actually help Miami International, especially considering the company's business model. When companies list on the TXSE, their stocks become available for options trading. Miami International could then offer options on Texas Exchange listed stocks, creating new trading opportunities. New stock listings historically tend to lead to increased derivative trading as investors seek hedging tools.
And speculation tools. I think the market at this point is more like the tail wagging the dog rather than the other way around. And options volume and options trading is what seems to lead stock trading these days rather than the other way around. But why are we talking about Miami International? It's a new company that just went IPO. And as you mentioned, usually we exclude these companies when we look at insider purchases. So why is this one interesting?
Well, we tend to exclude them primarily because insider purchases often come as part of the IPO process. But this week, we saw an insider purchase shares of this new company separate from the IPO. So he's buying shares out on the open market, and that insider was none other than Murray Stahl. Mr. Stahl is the co-founder and chief investment officer of Horizon Kinetics, and we used to see him and his firm purchase shares of Texas Pacific Land Corp. Day after day. Texas Pacific Land, or TPL, is one of the biggest landowners in Texas and earns royalties from oil and gas drilling on its land. And every day for the past 2 to 3 years, Mr. Stahl would purchase shares and the price of TPL would soar. While TPL has come down slightly in the last year, Mr. Stahl's performance, including his dollar-weighted return and his IRR on his insider purchases, have been quite impressive. The performance of Horizon Kinetics' concentrated bets in the oil and gas industry, and specifically in TPL, helped propel one of its funds to the top-performing mutual funds list in 2022. 3 out of 5 of the top performing mutual funds in 2022 were actually Horizon Kinetics funds as well.
I remember a friend sending me an article about him and the fund being the top performing fund. I also remember you and I looking at it every night and we were trying to figure out why he was buying stock of TPL. If you remember, he did stop buying stock for a few months. I think there was some issue with the management team.
I believe.
Yes. And that could have been a great buying opportunity for us. But it's good to see that the outcomes have been good for him and he restarted buying once that management lawsuit was settled.
Exactly, and he continues to buy shares of TPL through Horizon Kinetics, but it's more like 1 share per day. However, he started buying shares of Miami International, as Mr. Stahl joined Miami International's board in July of this year, but has been a member of the BSX Council, and BSX is one of the stock exchanges that Miami International owns. He's been a member of the BSX Council since 2014, and a director of MIAX Futures, one of Miami International's futures markets, since 2013. Horizon Kinetics also happens to be Miami International's, or one of Miami International's largest shareholders, which makes the additional insider purchases of the company by Mr. Stahl and Horizon Kinetics all the more fascinating. He seems to be wanting to add to his stake. It is worth highlighting that Mr. Stahl filed his purchase of Miami International quite late. His $1.2 million purchase that was filed this week was actually made in the last few days of August, when the stock was trading around $36 per share. He did pick up 4 more shares this week, a purchase so tiny that we would typically pay it no mind, aside from it adding on to that much larger $1.2 million purchase, which was filed at the same time.
I know you mentioned he sometimes bought 1 share of TPL each day, but it's worth mentioning that each share of TPL is almost $1,000 per share, even after taking into account a split that happened. Switching gears to activists, Acadia Healthcare is an inpatient company that focuses on patients with mental health disorders, eating disorders, and substance abuse or addictions. The company has nearly 12,000 beds across 262 locations across most of the United States. The company has a market cap of $2.5 billion, and as you would expect from a hospital-type operator, a lot of debt on the balance sheet that pushes the enterprise value of the company to almost $5 billion. I was looking at the stock, and it has lost nearly half of its value over the last year on account of declining revenue and earnings for 3 quarters, from Q3 2024 through the first quarter of this year. Things got better in the second quarter with both earnings and revenue rebounding on a sequential quarter basis, but earnings were still down year over year. As you would expect, investors are clearly not happy with the company's performance, and Chrome Capital Management, which owns 5.5% of Acadia Healthcare, sent a letter to the board reiterating that the company should pursue a formal review of strategic alternatives, including a sale, to maximize the value for its shareholders. The investment manager also highlighted eroding shareholder confidence in leadership and incremental changes that are no longer sufficient. So they want like a big picture, bold idea strategy from the company. Speaking more broadly, behavioral health services, whether it is an inpatient or an outpatient setting service, received a lot of attention over the last 10 years as stigma associated with mental health faded and new treatment options became available to patients. When reading about Chrome's involvement with Acadia, I was reminded of another behavioral health company, LifeSciences, that decided to go public in mid-2021 at $18 per share and peaked at a little over $28 per share a few days later before starting a long descent to the current $5 and change level.
I think what really hurt LifeStance and caused that descent was the debt it had taken on as it pursued a roll-up strategy by acquiring several outpatient psychiatric service companies. No?
Yeah, that's right. I guess investors still have brain damage from thinking about Valiant Pharmaceuticals and its roll-up strategy that ended in a big disaster. LifeStance actually showed up on my radar again in August after I saw the first insider purchase of the company when a director purchased shares at prices ranging from $4.30 to $4.53. Not quite as long as a 17-year wait that the director of Progress Software did, but it was interesting to see that nobody else had bought shares until this director at LifeStance stepped up. When I pulled up LifeStance financials, it looked like a lot of things were starting to head in the right direction, including rising revenue, the company inflecting to positive earnings after years of losses, and more importantly, the debt on the balance sheet was starting to come down. Roll-ups are tricky both in terms of the amount of debt companies end up with after the acquisitions, as well as the integration issues that follow after those heady, fun acquisitions take place. Things are even more complicated for services companies, where the talent can easily walk out the doors, as companies in the healthcare services space like Pediatrics, Medical Group, and Lifestance have experienced. I will continue watching both Acadia and Lifestance over the coming quarters, but it looks like Lifestance is further along the process of turning itself around compared to Acadia.
We'll wrap up our activist section by talking about one of the smallest but easily the funniest pieces of activist news that we saw this week, which was the activist Ancora Holdings releasing a statement stating that they applauded and appreciated the news that the railroad operator CSX had replaced its CEO, and said that it expected his successor would find a merger partner. Ancora Holdings had told the railroad operator back in August that it should pursue a deal with a rival or replace its chief executive if it didn't. The hedge fund was prepared to launch a proxy fight for board seats later this year if CXS didn't heed its advice.
Why was Ancora so keen on CSX going ahead with the deal?
So Ancora had highlighted that the company's operating ratio had risen under the previous CEO's tenure, indicating a decline in efficiency. The hedge fund believed that CSX should explore deals with both BNSF Railway, owned by Berkshire Hathaway, and Canadian Pacific Kansas City Southern, and asked that CSX formally announce that they had hired an investment bank to explore strategic options in order to calm anxious investors. It looks like a deal doesn't quite seem to be in the books for CSX just yet. Warren Buffett very soon after shut down speculation of a blockbuster railroad merger, saying that his company, Berkshire Hathaway, was not looking to buy another train business. Union Pacific also did not reach out to CSX until it had already struck an exclusive arrangement with Norfolk Southern, and Canadian Pacific Kansas City announced that it was not interested in participating in an immediate rail industry consolidation soon after. As I always like to say, let's transition over to C-suite transitions, the last section of this podcast. We've been bringing up John Paulson somewhat frequently, the billionaire hedge fund manager best known for his bet against risky mortgages in 2006 and onwards, accurately timing the implosion of the housing market and the Great Recession, making more than $15 billion for his firm. One of Paulson's largest holdings, making up about 16% of the portfolio, is Perpetua Resources, a mining company that's seen its stock soar by over 140% in the last year, primarily driven by the craze for anti-money.
So, not for money, anti-money.
Sure. Antimony is a naturally occurring silvery white metalloid, primarily used in alloys to enhance their strength and hardness, particularly in lead-acid batteries. It's also a key component in flame retardants and is used in the semiconductor industry. As a result, antimony has applications ranging from technology and defense to grid capacity storage batteries. However, the US has no domestically mined source of this mineral, and China, Russia, and Tajikistan control more than 90% of global production. China is actually starting to restrict exports of antimony to the United States, which makes finding a domestic source of this mineral all the more important. Perpetua, via their Stibnite Gold project, has one of the largest economic reserves of antimony and could supply approximately 35% of US demand in the first 6 years of production. It was then interesting to see that this week, Perpetua Resources CFO resigned from her position and had announced her retirement at the start of next year. She will remain with the company as a non-executive employee until her retirement date, which is a little bit odd because either we see these CFO or C-suite level executives retire immediately, or they retire when they leave their job. It's rare that they transition to a non-executive role for some time. As her replacement, the board has appointed Mark Murchison as a new CFO, and he has previously served as CFO and Secretary of US Vanadium and has held senior finance roles at Alacer Gold Corp and Rio Tinto Group.
I'm still trying to get over the fact that this very important mineral is called antimony, and people are making a lot of money out of it.
Yeah.
Anyways, to wrap things up, we were both at the Ideas Conference in Chicago earlier this year and got a chance to catch a presentation by USA Rare Earth, a company that claims it leads the supply of domestic rare earth materials and magnets. The company talked a lot about its round top deposit in West Texas that holds 15 of the 17 rare earth elements. We both came away from the presentation thinking the company has a long ways to go before it starts extracting these rare earths, but investors have already bid up the stock in anticipation of this happening. The stock is up 138% over the last year, including more than 68% since we attended the presentation. The jump was related to speculation that the company is in close communication with the Trump administration. Companies like rare earth mining companies, MP Materials, and lithium exploration company Lithium Americas have benefited from the Department of Defense and the Department of Energy taking stakes in them. This is highly unusual. I don't think we have seen the government step in and start taking stakes in companies unless there was a big problem or a crisis. We were also surprised to see the sudden departure of USA Rare Earth CEO Joshua Ballard, who resigned effective October 1st, 2025. The company has appointed Siemens USA CEO Barbara Humpton as its new CEO. And I initially thought that the big jump in the stock was related to her appointment, but it actually had to do with this close communication the company is claiming it has with the Trump administration.
And with that, we will wrap up episode 39 of the Special Situations Report. What we covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities, such as a merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.